Jyotivardhan Jaipuria, who's founder and CEO of Valentis Advisors, joins in with his perspective on the markets and the budget slated for tomorrow. Jyoti, it's great to have you on the show. Thanks very much for taking out the time. Good morning. What is the expectation, really?
Hi. The budget is tomorrow, but that's a vote on account. So I don't think that is really going to be a great market moving event. I think the big event was probably the Fed, which was last night, where, Fed said two things. One is that the rate hike is more or less done. And second is that they'll not shrink the balance sheet as much as, was the general expectation. Because, if you think of the Fed balance sheet, or if you think of the major central bank's balance sheet, that's expanded from some $7 trillion 15 years ago to close to $20 trillion now. So the worry was, are they going to go back to 7, which they clearly said they would not be doing. So I think, this is very significant. Last 10 years have been the year of developed markets. They've outperformed emerging market by a big margin. Probably, this could mark the change of this big trend where we start seeing emerging markets start to do better than developed markets.
Yeah, I know, but we need to still zoom into how tomorrow can change at least the near-term outlook. Or you think the markets are completely disconnected with the event of an interim budget, if not a full-fledged budget, but an interim budget, and what the government may say or do in terms of managing the fisc, not just for FY19, but also indicate to the market on how the road looks like ahead for FY20?
Frankly, my view is like most budgets don't really change the course of the market, because by now budget making has become quite transparent. They have a 5-year fiscal roadmap, and so people try, and at least most governments are trying to somewhere meet that fisc target, though they keep extending their deadlines. So here, as we get into the budget, it is just a vote on account. So what they say for next year may not be very material, because once the new government comes in, we'll be more sure of what the policies are. But the general expectation as we get into it is that they'll miss the fiscal deficit target for this year, and they're going to miss it by 0.1 or 0.2. So to some extent that is baked into the market. The second expectation is that we'll see some announcements coming for the rural farm, probably something close to a universal basic income. How they fund it and whether they'll really spell out details or it will be a little vague is something which we'll be watching for. And third is probably there'll be some tax breaks for the middle class. But by itself, it's not really going to change the course of the market. For the market, probably it's whether we get the earnings growth coming through or not, which is more important, because at the moment valuations are not cheap. So, you can justify these valuations only if the earnings growth actually starts to materialize.
Talking about valuations, the common opinion on the street is, the more dominant view is that, we are from 18-19 times, 1 year forward, we are perhaps trading at the upper end of our valuation band. I don't necessarily concede to that view. I think, there is still scope for the market to go higher from here as earnings kick in, especially that's the expectation, as we go into FY20. How do you look at the return probability, or rather the return potential for the market, with the expectation of earnings picking up from here?
Yeah, so we are somewhat similar view. So markets are expensive. The only reason we can justify is that we think we are at the cusp of probably a bottom of our earnings cycle. We think next 3 years, 4 years, we'll have a very strong earnings growth. We're expecting earnings to double out in the next maybe 4 to 4.5 years. So, that's the sort of earnings growth we are looking at. If you see the market last 4 years, all the returns came from a valuation re-rating. The next 4 years, all the returns are really going to come from earnings growth. So, earnings growth is very critical. It needs to come. If that falters, then probably we'll not see returns on the market. If we look at near term, we are probably in a scenario where, the next 4 months, 6 months could be a period where market has a time correction. I think it will also have a price correction. So for us, it's more like if we get an opportunity to buy the market closer to 10,000 levels, 10,000, 10,200, then that's from where we can make, decent money for the year. Otherwise, probably at these levels, we would be looking at single-digit returns for the market for the full year.
Right. Let's talk about sectors. You've seen a slew of earnings come through. I don't know whether you talk stocks, but I want to particularly focus on ICICI Bank and that improvement in asset quality. Is a large part of this turnaround that is around the corner for ICICI Bank in the price because the stock has run up in the last 3 months, or is there more to come? Can investors still look at buying? I mean, is there value at the table at roughly 2.2, 2.3 price to book?
Yeah, so we don't get particularly into stocks, but just in general, I can say that we are very bullish on corporate banks. Last 5 years, these underperformed a lot, and it was the retail banks which did well. Next few years, the NPL cycle is going to improve dramatically. Provisioning will come down a lot for all these corporate banks, and to that extent, these banks will be able to show very strong earnings growth. If you think of FY20 earnings growth for the street, most consensus is around 20%, and a lot of that is coming from the banking sector. Nearly 55 to 60% of next year's earnings growth for the whole Sensex is coming from the banking sector, and a lot of that is premised on the corporate banks doing well, where NPL provisionings come down. I think the other thing which is going to help a lot in corporate banks is the whole bankruptcy code. I know that a lot of it, we've seen delays relative to what was expectation, but I think this whole bankruptcy code and the bankruptcy courts are now shifting the onus of power away from the borrower to the lender. So banks are getting more powerful. More and more borrowers will be keener to settle with the banks rather than go to the bankruptcy court, because then they tend to lose control over the management of the company. So I think next few years are going to be very good for corporate banks in general.
Okay, so very quickly then, give us your broad overweights and underweights in the market currently.
So if you just look at corporate banks, is one of the things we are overweight on. The other sector we are overweight on is the capital goods and the infrastructure sector. So again, something which is not really consensus. The sector has not done well for a long time. But I think now we are at the cusp where valuations have become cheap enough. A lot of the earnings growth will be driven by this sector. So that's the other big thing we are overweight on. We are underweight on telecom, which we've been for a long time. We don't like the consumer staples because I think they are very expensive. So these are good companies, but I think valuations are very expensive. Last 10 years these have got re-rated a lot, and I think we probably will see things like capital goods get re-rated now relative to the consumer staples.
Okay, Jyoti, we let you go at that. Thanks very much for taking out the time and share your views on the market.
Thanks a lot.